We are in the end of the July real estate market. And in today's episode of the Real Estate Podcast with me, Nico James Bach, a broker with Royal LePage Signature Realty in downtown Toronto, I'd like to help you take advantage of today's residential market by knowing the three key indicators: supply indicators, demand indicators, and price indicators. Knowing these three key indicators will give you more insight into what is happening in today's residential market in the GTA. Before I do that, I want to mention that there was a recent death that I suffered. A friend of mine, she went by the name of Ava Paradiso on her Facebook page. In all her Facebook or social correspondence, that was the name she used. So I'll continue to use that name as I mention this loss. Ava Paradiso passed away in the early morning of Sunday, July 23rd, so just 5 days ago. And she leaves behind not only a dedicated friend, but also a daughter, a disabled daughter, who is 23 years old and is managing with very, very severe physical and emotional limitations. So I am in the process of preparing the funeral and or cremation arrangements. And that is what I will be doing for the next 2 days as I finalize those arrangements, while obviously speaking with the other executor and with Ava's daughter. So having mentioned that, I'd like to continue with today's podcast. I will dive right into it by mentioning that the first key indicator is the supply indicators. So despite rising inventory levels across the GTA, overall housing supply remains low. This has been a recurring theme over the last 2 years, with the increase in demand, which I'll speak to in a moment. Inventory levels remain quite low. The overall amount of supply in the market remained low at month end. These numbers refer to June, which is the completed month for which we have the market facts. Active listings down 12% year over year to 14,107 units. And that is 15% below the 10-year average. While the level of inventory moved up from 1.3 months in May, which was also a 14-month low, to 1.9 months in June, it was directly in line with the 10-year average. So the months of inventory indicates how many months of supply we have if no new properties came to the market. So if nothing else came to the market, nothing was listed, nothing was sold, we would run out of inventory in 1.9 months. And that's what months of inventory indicates for the month of June. We are nearing the end of July, and I suspect that the level of available inventory would hover around 1.7 to 1.9 months. That will remain to be seen. The stats for July, will be available in the next 7 days. So within the next week, I'll have the stats for July. The next key indicator would be demand indicators. So June saw a seasonal slowdown in home sales. Now that is in direct relation to the recent BOC interest rate and hike announcement. The seasonal monthly decline in sales was experienced across all price segments during June, led by 22% decreases in volume from May for the $1 to $1.249 million mark and $1.5 to $1.749 million price bracket. So sales in the 900 to 999,000 price bracket held up the best compared with May, posting a 10% monthly decline. On an annual basis, sales increased across all price segments other than the 700 to 799,000 and 800 to 899,000 ranges. Year over year sales increases were strongest in the higher end of the market, led by a 41% increase in activity for $1.75 to $1.99 million homes, and a 37% increase in homes priced at $2 million and over. The third key indicator would be price. So we just spoke about price brackets. Average selling prices saw positive annual growth in June. A still highly competitive market saw the average home sell for 104% of its list price in June, edging down from 105% in May. So generally, homes are selling above list price in this competitive market. For the first time in 10 months, average selling prices recorded positive year-over-year growth, rising 3.2% from a year ago to $1.182 million. Prices were up by a total of 8.5% over the past 2 years and by 27% over the past 3 years. So we're still seeing price appreciation. It's just lower than what we've witnessed in the past year. So while still 11% below the all-time high in February 2022, month-over-month prices dipped by 1.2%, which is generally consistent with typical seasonal norms. So we're in a summer market, so that 1.2% price dip is in line with what we see generally during a summer market. So the fact that GTA housing prices returned to positive year-over-year growth in June should provide a signal to the market that the correction everyone is talking about is likely over. This should bolster confidence in both buyers and sellers. So a lot of people are speaking about housing correction. When will it occur? Is it over? So the definitive answer based on the stats that I've just read, I've just gone over, indicate that the correction is likely over. We don't have the July numbers yet, but we are of the impression that the correction, which took place over the past 12 months, more or less, is likely over. What about interest rates? Well, any further interest rate increases by the BOC are expected to be marginal at this point. Rate holds and possible small rate increases are predicted for the next 2 quarters. While the economy is running a bit stronger than anticipated by the Bank of Canada, inflation is clearly slowing, decelerating from 4.4% in April to a 2-year low of 3.4% in May. We'll see further deceleration once we have final figures for June and July. The BOC interest rate hikes were the catalyst for a lot of the price fluctuation and stagnation that occurred starting in March 2022. And they continued all the way through to January 2023. As interest rates have risen 325 basis points over the past year to June, and a total of 450 basis points since the low during COVID, rates are still at a restrictive level for the economy, which should cause inflation to actually fall into the Bank of Canada's target range of under 3%. This should eventually lead to decreases in interest rate, first for fixed rate mortgages in the final quarter, and then variable rate mortgages likely sometime in early to mid 2024. We can't and shouldn't ignore the impact new immigrants coming into Canada have on the economy and on prices. With Canada's population growing at a record pace, the medium-term outlook for the GTA housing market remains, for the most part, positive. In the short term, some further caution on the part of buyers can be expected as rates edge up slowly and at a moderate level, benefiting the rental market, although low supply levels should limit any potential softening in prices. So it'll be the balance between selling prices and actual and list prices will continue. Sellers are expecting to maximize to get the most out of their properties, and some of them have unexpected or unrealistic expectations as to how much they can actually get. We as realtors have to be very, very careful when we price housing as to not to put an overly inflated price on properties based on sellers' expectations, but to be more realistic based on what is actually happening and based on what buyers are expecting and experiencing as a result of the challenges presented by the increase in interest rates. That's it for today's episode. I will have the full stats available through my various channels, Instagram, Facebook business page, as well as LinkedIn business pages. So you can view the full stats and a full description of those stats on those channels. My contact information is always available to you, and it's presented here at the end of this podcast. So I will be presenting to you the July stats when they become available, and that's expected within a week's time. So that's it for now. Ciao, ciao.